Okay, thank you for joining us today for the third quarter. Is this the third quarter?
Second quarter in terms of reports.
Right. Of the investment, committee meeting. Thank you for Soltis being here, and Voya is here online. And looks like we have Paul, one of our newest members. Welcome, Paul. And you're welcome. And I think other than that, we are good to go. Anyone have any questions, official questions, before we start? All right, let's start by approving the minutes from our last meeting. Anyone have any questions or changes or concerns about the previous minutes? If you need to review them, they're on page 5 and 5 through 7 in the booklet.
I'll make a motion to approve.
Have a motion to approve. Do we have a second?
Second.
We have a motion and a second. All those in favor say aye.
Aye.
Aye. Motion will pass 5-0. 5-0. 6-0. All right. Well, there's nothing that we need to speak of from the committee side of things first, so we're going to turn it right over to Soltis.
Okay. Good afternoon, and thank you as always. We're happy to be here and appreciate the time and the committee of being here in attendance. As always, we have a good full agenda. We'll go through those real quick, starting on page 4 and 5. Forgive us a little bit for the formatting and printing. That agenda's lengthy and it's there. But minutes have been approved. We'll touch base real quick on some regulatory things. Was in Washington, D.C. a couple of weeks ago. There are some upcoming changes, new legislation to kind of fix some of the things in Secure Act 2.0. We'll touch on that. That we'll go through. And then, of course, we'll go through the investment review of all the investments in the plan. From many of you recall from our last meeting, one of the requests of the committee was to have us look at a real estate investment option as well as a inflationary protected fixed income option. So we've got an option for the committee to kind of go through and look at on those. And then, of course, we'll update the efforts that have been made here in the last quarter as well as year to date in terms of supporting your participants in education. We'll then make sure that we give time to Voya to go through their quarterly report and an update on the EASE account, the ERISA account, as we typically call it, and that will kind of conclude, I think, most of the agenda items. So as always, is there any item that's not on the agenda that we need to add to ensure that we cover?
No, I think we're good.
We keep our streak alive. On the business, we'll start with the business calendar on page 9. I'll let Tucker kind of begin to go through that, just in terms of, again, all the areas in which Soltis is engaged in working on the plan throughout the year.
There we go. As a reminder, you can review this whenever you'd like. We're not going to go through this line by line, but we just like to take the highlights of this business calendar, especially since we're meeting on such a frequent basis. We know it's easy to keep everyone up to date with what's going on. So maybe just the highlights of the plan is we'll still continue to emphasize the importance of the Secure Act 2.0. And with 2024 well within range, we're going to want to start looking at the mandatory provisions as well as the optional provisions and look more seriously as to what we want to consider adding or keeping out of the plan. And so, like Tyler said, we'll review that together a little bit more in depth today. Just as a reminder to the committee, the plan continues to perform at a high level, receiving the Platinum Award for 2022, and the metrics it met were mostly based around high participation, which, in part we think is to the internal team you got here that's pushing it, and the automatic enrollment that the plan uses. Both very good things to show for the participants.
Can I maybe just add there on that Platinum Award, that is the highest award that we give. It's based on multiple criteria, participation being one, but it's also looking at the investments, the quality of the investments, the education, the participation, as well as what's called income ratio. And that the income ratio is probably the most important. I know we have a couple of new committee members, but what we do is we look at what's the average income replacement for the employees of Utah County in your plan. In other words, those participating in your plan, we look at and say, okay, how much of their income are they on track to replace on average when they retire. And that number, if it's above 70%, which is where a lot of pension plans run, so if you're north of that, and which Utah County is, that's a really important metric. So it's one of those, I think, in looking at your plan, hitting all three of those areas is difficult to do. It's a pretty high bar, and we congratulate you on it. You've got a good plan and good design that's, I think, doing a lot for your employees.
And it reflects in education as well, and we'll talk about that as down here in a bit. We'll review a little bit more about the TRO CITs. As a reminder, we're in the process of shifting. In the plan, it currently has about $15 million in these target date funds, and the T. Rowe Price Fund has agreed to let us use their lower share class, and so that's been the objective. The funds stay the same; the participants now get a lower rate, and so that's what we're going for. We know there's a bit of confusion there with some shifting of roles, but we'll make sure to work with the right team members to get that taken care of here soon. The plan continues to perform well. We know when it's good, it's great, and when it's bad, it's bad. But this year, it's a good year, and the funds are doing very well, especially the active managers. So on the far right column there, the investments reviews, you see the average excess return. So it's 2.04%, which is a reminder that is the performance net of fees that participants are getting in the plan on average. So above their benchmark, which we think is a tremendous achievement to see within the plan. The managers continue to perform above their benchmarks. And so we do have one fund on watch, and we'll be going over that today and just talk about our comments there.
Maybe providing a little context as well. From our standpoint, investment, if we can achieve an excess return of over 1%, those are very strong numbers. I'm not sure as long as we've been on this plan if we've ever been over 2% like we are, so we'll take it. That's not Soltis beating our chest, but I think sometimes we've had some good managers. We've had good, strong performance. The markets have been good, but this, of course, that 2% is in relative terms. So it's looking at how the market's done, which again, as Tucker alluded to, this year has been a much better year than last year. But right now we have 9 managers in the plan that are performing well above that 1% and only 1 that's on watch. So our ratios are pretty good. And when the markets are good and we can have strong performance, we'll take it.
Yep. Yeah, set expectations, just like we do with the participants. You know, it's not very common to have that 2%. Much like in COVID, people kind of got used to that 30% rate of return for their account. So, I mean, we'll take them as they come, and we are happy when that happens. So, ongoing education efforts, on a monthly basis. We're here. We're seeing a lot of turnout for these meetings, which is great. Even when the market's good, to know people still want to talk about their accounts. We've held recent training for people that have questions about the windfall elimination provision and the government pension offset, and those are recorded and put on the intranet here. So, any questions about the business calendar? Comments? Okay.
All right. If we kind of go into the fiduciary section, beginning on page 11, I know we touched on this briefly, and I think what I'll say here is in kind of before the end of October, we'll look to schedule time with the committee or maybe the entire committee or those that need to be part of it. But we want to help you look at, there's a number of provisions that, again, this is for ERISA-based plans. So you guys are always an exclusion because you're not governed by ERISA, but these are provisions that will likely be available to you. The mandated ones we'll kind of go through with Voya as well, and then a number of these that are optional. And so I think we know that particular conversation will probably take the better part of an hour, if not longer. As you can see, there's quite a few of these provisions that become effective there's some that become effective this year, and those are in place. Voya is already working with those that are there. And then provisions that become effective next year. And so I think prior to our next meeting, we'd like to probably schedule time with the committee, be able to dive in a little deeper on each of these, and then work and have Voya join that meeting so that we can discuss their capabilities about going through those. But I'll point out a couple that I think many of our clients are looking at to consider for next year. There's a few for you to remember. One is beginning next year, at least for ERISA governed plans, catch-up contributions for those over the age of 50 have to go in as Roth contributions. So again, you're not an ERISA governed plan, but that's one that is catching the eye and paying attention to beginning in 2024. The RMD rules have changed. The ages have gone up. I know Voya's already kind of put that in place. I think that's one, even though you're not an ERISA governed plan, that would probably make sense to move lockstep with those RMD dates that are in there. A couple of the ones that we'll talk a little bit more about, and these are all in the packet. So prior to us meeting and going through that, I think they're please feel free to read through these. But there's a couple that I think are more pertinent or more at the top of the list for many of our clients. One is beginning in 2024, plans will have the option that they can match Roth. So the contributions that they put in the plan as a match will go in as Roth. There's a little bit of gray area. Most providers are waiting to hear from the Department of Labor and the IRS define exactly how that tax treatment will go to the organization. Again, probably not as big of implication to you all, but that would be a big change to plans. Right now, you have Roth in your plan. Participants can choose it, but it's the only dollars that are eligible for that is the money they put in. This would change to allow the match dollars to go in and go in that Roth bucket as well. The next two are student loan provisions and payments, allowing your plan to match based on student loan payments. And then the third one is emergency savings that would be housed inside of the plan, would allow you to offer like an emergency savings account or kind of like a rainy day fund that would help your employees save. And that account would reside inside of it's not inside of the 401k plan, but it would, when they log into their account, they'd see it with Voya, and there's some things. So we'll go through some of those things that are on there. I think those, again, are kind of the most top of mind. And then we'll even cover, there's a few more provisions that become effective later in 2025. But let me pause there and just see, is there any questions? I know we kind of touched on that quick. Again, we'll plan a follow-up meeting to go in more detail, but.
Yes, I have a question. I'm curious if we could take sort of a training approach for our next session, as opposed to like this meeting where we meet more on a administrative nature and
Yeah.
we meet and just train about this.
Sure.
Because there's the things we have to do. We realize that those are in place, and there's the things we can choose to do or not choose to do, and those are obviously the things
Yep.
we really need to dive into. So I'm just curious what everyone thinks about that, taking that approach instead of, the public meeting, we have a training session, we learn about it, and then we can come back to a public session and, essentially make, whatever recommendations we think is best.
That makes sense to us. I'll certainly defer to the committee. I think you'll see on the agenda with new committee members, we have some additional fiduciary training that we'd love to be able to kind of go through with them, and we could probably wrap that all together. Fiduciary training is something that's required.
Yeah, I think that would be great and ideal if we could wrap it into a training session for this group.
Okay.
And call it that.
Yep.
And then you guys could just schedule it with this, because we're really easy to schedule with all these people. and then, but anyway, I think that'd be ideal.
Okay.
We'll take these pages out and send it to the committee after the meeting, just so you can have it for review by the time we do that meeting.
Perfect.
So if I want to make sure I understand that, Ralph, do you want to plan, instead of the next meeting that we had, plan to have that meeting in place of the next meeting, and then the fourth quarter meeting be back to the formal public forum?
That is what I'm hoping. Yes.
Okay. We're happy to do whatever works for whatever the preference would be for the county.
No objection.
Okay. I think it would be very, very good use of our time.
A couple points of interest on the Roth contribution on the match. I think it'd be helpful for us and probably the employers to know how, when you have a mixed bag between the Roth and the traditional contributions, how tax treatment upon withdrawal, right?
Yep.
So is there a rule about what's coming out first? Is it coming out? I'm on a ratio. I think that'd be helpful.
Yep.
To know. And it seems to me also like the Roth contribution probably wouldn't cost the county any extra, right? It probably shouldn't matter to the county, which
Yeah.
we're going Roth or traditional on the match. On the student loan trainings, I assume that would just be an extra expense, right? Or is it coming out of your withdrawal, or
So what it does, it
or
allows
should we wait
your,
until we do a training and get into
Yeah,
that.
I mean, I can answer real quick and then we'll dive into it. But with the student loan provision, what it allows you to do is to say, hey, we're going to match contributions, or we can also match student loan payments that our employees are making. So it would allow you to consider both and say, oh, they're contributing 2% of their salary towards a student loan payment. We're going to match 2% into the plan as if they were putting 2% into the plan. So that's what it allows you to do.
As far as expenses go, it's going to be the same if
Yep.
they're participating in the plan, but what you might find being a bit of a hassle is verifying if the employees are putting that money towards actual loans.
Yeah.
And you might have to pay for a service for something like that to find some way for them to administer.
And is there any tax advantage on that?
I don't believe there will be to you. That's kind of for taxable entities, private for-profit
Yeah.
companies. That's kind of their big question is, are those dollars, if we put in and they go into Roth, do they get the same benefit that they do today for the tax treatment for a traditional contribution? So,
Yeah.
and sadly, we're
We don't know.
close to January 1 and the Department of Labor and the IRS has not fully defined that yet. The expectation is they're going to treat it the same, but they haven't come out and said that 100%.
Maybe to wrap that up too, I mean, that's a common theme of interest for our plan sponsors is to look at those two, like Tyler mentioned. And so we already have thoughts on education that we'll be offering and recordings we can do or meetings that we can hold to make sure employees know that if that does apply to the plan, exactly what the tax, how it does affect them, right? I mean, obviously, we're not tax planners. We'll give the proper disclosures, but we can go through the impact that would cause if they had that split bag.
And if the county wanted to do something like that, how much discretion does Voya have? Whether they offer that or not is also another hurdle to
Correct.
to-
So
to
that was
cover,
kind of
right?
the last point I was going to make is, especially on the optional provisions, not every record keeper, because it costs them money to build their systems and modify them to account for it. So I think when we have that meeting, we'll absolutely want to have Voya be part of that meeting so that we can talk about the provisions and then let Voya also discuss. And I know Bishop's on the line. Bishop, when we get to your portion, if there's any comments you'd like to make around kind of Voya's progress around that, it's a big lift. Of all of this that's in there, the record keepers, Voya and those type of providers, they're carrying the heaviest load of trying to get their systems ready to handle all this when you're legally.
Sorry, it looked like I was having trouble unmuting myself for a minute, but yeah, I can definitely touch on that both at the meeting and then at a high level a little later as well.
Okay. And I guess what I'll say is I think there's a lot of good options that are available in the plan conceptually where it gets a little nitty gritty is in the implementation. Like student loan's a perfect one. It sounds good conceptually, it makes a lot of sense, but then at the same time, how does the county begin to track student loan payments that are being made by your employees and verify them, match them, make sure it's done correctly? Those are the type of things where it starts to get a little murky. So, okay. Maybe to finish on that conversation, I will say, again, I think this committee is aware, Soltis, we have the privilege of sitting on what's called the Government Affairs Committee for the National Association of Plan Advisors. So I was in D.C. just a couple of weeks ago, meeting with lawmakers, met with Senator Romney's office, as well as Senator Lee's office, and then we met with a number of lawmakers. The large objective of those meetings is there's a number of fixes from Secure Act 2.0. When that bill got passed, there was a few things in there some that were kind of overlooked and some that were just flat out mistakes. And so right now they're trying to pull together a bill to likely attach to a spending bill between now and the end of the year that would fix some of those around that. They're pretty minor. They're pretty minor in how they're done. And so, but I think it's likely to see another piece of legislation that will get passed between now, hopefully the end of the year, or even in the first quarter of next year that will modify a few of the things in Secure Act 2.0.
You seeing any movement on trying to get rid of WEP and GPO? Because I'm reading a few things that there's a bill out there currently to remove it, and there's some talk in various retirement bills that they would try to get rid of that. What do you think are the odds?
So I don't think they're high right now. I think there's a number of, I would say this in terms of our meetings out there, there's a number of kind of things that have kind of been put out on the table that I feel like are a little bit of, hey, let's put them out there and start the conversation. I think I would put those in that category for now. And we'll kind of see most of the effort and attention right now is being given to, there's a couple of these kind of, I would say, mistakes in the bill that really need to be corrected. So it's getting them fixed and getting to the lawmakers and letting them know, hey, this needs to be corrected, and understanding what it is so that we can get it through. But it's, every time we're out there, I would say there's about 25% of our meetings and conversations around, hey, there's a couple of bills that have been put together by these two congressmen or congresswomen, and it's kind of trying to put things out there and see if we can start to get some traction. And again, I think those are kind of fall in the category. There's a few that we look at and say they got a long way to go yet, but we'll see. So, not clear as mud, right?
I mean, we wish it would happen, but perhaps not a lot of hope that it would, especially in the short term.
Yeah. It like I said, I think it'll kind of stay. I'd say just stay tuned there a little bit. You would think some of the most common sense, and those you look at, they make a lot of sense. I mean, digital delivery. It took almost a decade to say, hey, it costs a lot of money to mail stuff, and it costs the participants. Like, if we can email them, which almost all of them have email, it saves $5,000 every time you do it for a pretty good sized plan. And yet it took 10 years to get that passed and done to where they could actually do it. So we shall see. Any other questions around that bill or any of those other items?
Nope.
Okay. I think with that, we'll move down to Bishop. We'll move down to the Voya report. If you want to be able to kind of go through that quarterly report as well as the accounting of the ease account.
Maybe while he's pulling that up, if you go to page 108 in the packet, that's where you'll find it.
Bishop, you there?
Oh, he's there. Oh, not yet.
I'm working on the air. I'm working on it. Silently.
Try again, Bishop.
You never give me your cell phone.
Not yet.
We're going to see how good you are at charades, Bishop.
Sign language.
You act it out and we'll guess.
What air are we talking about? The air can do that air. Oh.
Hello?
There you are.
Oh, okay. Are you turning over to me to go over my section now?
Yes, if
Assuming?
that works.
Okay. All right, let me share my screen, go through this real quick. Apologies for the technology, and thank you for accommodating me with the scheduling that I had myself here. I appreciate it. Okay, so let me go to share this. All right, real quickly, we'll go through some of this. We'll pick up a little bit on Tyler and Tucker's comments from earlier on with regards to the quarter. I know they have some analysis going through the markets and the conditions, coming up here shortly as well. But, as this slide shows from a cash flow perspective, again, another positive quarter for the plan, positive appreciation in all three plans, resulting in $153.9 million in 401k assets, $20.9 million in 457 assets, and $2.6 million in the time-limited plan. So all good activity, all positive as well, and on track with what we saw last quarter also. Looking at the E's and spending account summaries, just to summarize that information for you. And I did run this through August 1st to pick up some activity that occurred in the middle of July as well. So the spending account balance, $109.9 thousand in those two accounts, 25.8 in the 401k account, and then 84,000 in the 457 account, contributing to that. Total available assets in the E's accounts are listed there for each plan. 13,000 in the 401k plan, 4.3 thousand in the 457 plan, another 5,500 in the time limited plan, for a total of $23,034.51, and then all total $132,942.40 for the plans as a total rolled up amount that's available as well. The following slides, I should say the accommodating slides with regards to the Ease account, break that out and then provide you the activity, both withdrawals and fees that occurred through the quarter. So you have that for your review as well. With regards to asset growth, you can see we're continuing to see growth in each of the plans over time, going back over the last quarters, last 4 quarters of activities, I should say. And again, graphically speaking, you've got that 160K in the 401k plan, 20.9 million in the 457 plan, and then 2.6 in the time limited plan as well. Similarly, you've seen growth with participants also. Leading into this discussion, I do, later on, we talk a little bit about participation rates and the like. I did notice on Tucker's slides, we have an outstanding item with regards to talking through some of the accounts that we're getting. I need to do a deeper dive with Brandon on that, just to so we can kind of go through. I think I know what the key differences are now, but this just gives you total plan participants. Again, slight growth in each of the plans, with the exception of the 457 plan, which has decreased slightly as well. In the Advisor Managed Accounts program, you can see the totals here as well. The 401 plan and the time limited plan roughly flat, with a slight decrease in the 457 plan again. And then the total assets that are in managed accounts by plan as well, 61.9 million in the 401k plan, 5.9, so a slight decrease in the 457 plan, probably more reflective of the assets that have moved out of managed accounts than anything there. And then the time limited plan, slight increase there to almost 1.2 million in that plan at the end of the quarter. We have been looking at the number of participants that are invested in a single fund. Real focus here ends up becoming the fixed account. And if you might recall, in past quarters, we were kind of watching that from a standpoint of seeing what type of activity was happening to track along with the idea of flight to safety. We're still seeing a little bit of an increase in participants moving to the fixed account. You can see in the 401k plan up slightly to 216 participants with a single fund balance. Slight decrease in the 457 plan down to 108. All the other funds have been remaining roughly the same when you look at them. And then in the time limited plan, that saw the biggest increase from 215 to 259 accounts with a single balance in the fixed account in that plan. Looking at participation, just to go over these numbers, and I said I'll follow up more on this to further clean this up. Slight decrease in participation based on counts that we have, 97% in the 401k plan. 457 plan stayed roughly equal at 17%, and then the time limited plan did have a jump in it, up to 88% for the quarter as well. Looking at distributions, I did want to spend a little bit of time here because I wanted to provide you a fuller picture given the increase that we saw quarter over quarter. And as you look at the total rollovers going out of the plan in this quarter and looking back quarters, this is the highest rollover amount that you've had. Not the highest total number of rollovers, which you see at the bottom there, the 76, but the 3.6 million is the highest dollar amount that you've had to date. We do break that out for you as we have typically by the top 10 rollover institutions. By and large, the largest amount of assets you see there, 1.3, almost 1.4 million going to URS, likely in the point of service buybacks for them. going down, over time. I think JP Morgan in the past has been pretty high. Fidelity has been higher as well. Couple things to note though, when I looked at your plan, which is it's a little bit unusual in this regard, there is a large amount, almost $500,000 in assets that were age 59 and a half active participant withdrawals. And I only point that out because not every plan allows for active participants to withdraw their funds. Usually you see some onesie twosies in that regard with regards to withdrawals, but roughly $500,000 that went under that category. Looking at full withdrawals, that was 2.2 million. And then we had another partial withdrawal of 532,000 as well. So that differential, if you will, going back to the prior slide of the 3.6 number, and then the total withdrawals, full withdrawals of 2.2, really comes out when you look at age 59 and a half withdrawals, partial withdrawals, and that's someone who might be terminated, but not taking their full balance, might be rolling half of it or a quarter of it or some factor of it, either to themselves or to another institution as well. And then you did have that larger, did have one larger death claim as well that was processed that feeds into that. So a little higher number this quarter, so I thought to take a couple minutes to talk through that as well. We're just recapping the loan information for you. Loans overall did drop as a total outstanding loan number, down to 172 outstanding loans. That breaks out to 145 general loans and then 27 residential loans. Overall outstanding loan balance, and even the balance by category is roughly flat in a lot of ways. Not a lot of differences there, but the new loans that you did have coming in, the 11, along with those that rolled off, is what kept the numbers flat overall for the quarter. A quick word with regards to participant access statistics. I mean, all of this, you've seen in the past before. Commentary here remains the same. By and large, participants are accessing their accounts through either internet or mobile app that we provide as well. VRS, or the voice response system, call center, smaller numbers there overall, but again, all good activity at the end of the day. Once people are interacting with their accounts, we know that leads to more informed participants, and participants are probably better prepared for retirement as well. Then just a couple quick slides to go over with you real quick from a Voya update perspective. This is just more informational in nature, something that I thought that could be beneficial to you. I mean, we've seen our firm do 2 quarterly reviews for sentiment of employees within retirement plans. And this looks across a pretty broad universe of participants, not just Utah County employees, but by and large, the sentiment is trending positive. As we've seen people that are either unsure, nervous, or frustrated, those numbers are coming down quarter to quarter, and we're seeing that positive sentiment going up as well. And then the final note here in our study, it might not be something that's a surprise to Rolf, for example, but 80% of the people that we are surveying saying it's important or extremely important for their employer to provide them information or help them better understand their employee benefit options. And we're just seeking to try to make sure we do that, each day as we go through our task as well. A little bit of coming attractions for you. We are going to roll out this fall an employee dashboard experience that's within the participant website. It won't replace the participant website, but as I understand, it's going to be a site that as you log in, you'll see, depending upon your use of it, all of your accounts in one place, whether that's Voya accounts or the ability to link in other accounts if you so choose. We're going to be tying into some of this, our financial wellness tools that we have as well, kind of bringing them front and center. And as we get closer to that, I can definitely make sure that we put that on a future agenda to give you a better indication of what that looks like, how it operates, and the like. Still, we're about a month away, I'm told, from it just being rolled out, so I'll be getting more information as we go forward, but wanted to at least give you a little bit of a coming attraction this point in time. This next slide is a little bit of a dangerous topic. I know these days with AI technology being front and center on a lot of people's mind, but I thought to make sure just to, in the course of our relationship with you, making sure you understand how we use AI technology from a firm standpoint. One of the biggest ways we use AI is in fraud detection. And without going into a lot of the details of that, there are different measurements we're taking on each interaction a participant has with us and using the scores of that activity to help us further detect fraud and help fight fraud. So we've got that. We have a chat bot feature that we utilize through the call center, through the participant app website, and then also some of our back office operations are generated or using AI technology to generate those activities. And then a final note on that, there are personal nudges or what we call personalized journeys that are sent out to participants in the plan. You might get one, for instance, in the month of your birth, just wishing a happy birthday. You might get one going back to those individuals that are invested in a single investment option. As we're looking to send a message at one point in time, then we will use, for instance, AI to determine who might receive that email, that text message that's coming out on that topic and push it that way. So just more of a high level review of how we're using AI technology, and so that you're prepared for that if someone should ask you with regards to our services that we provide to the account. And then last quick note, just a little bit of an accolade. We did receive an award from Fast Company magazine. This is just regarding the use of our My Voyage personalized enrollment guidance tool. This is not a tool that's currently used by the county, but it is something that's available for you if you want more information on it. It's really designed at the end of the day to help people understand the full gauge of the enrollment process, and that's not just enrolling in the plan, but understanding their other benefits and using the benefits in a cost-saving manner that might help them save more for retirement. So, with that, I'll pause in case there's any questions, but that would conclude my report.
Great. That was excellent information. I was curious about the active employees, withdrawing at 59 and a half. Is that something we should look at as not allowing?
Rob, there's kind of, I think, a mixed bag on that with regards to using that tool or that capability. I've got probably half of the clients I work with have it, half don't. So it's not that there's any one right or wrong answer per se. It's just that at this point in time, we're not seeing a lot of activity in other plans. In the plans where I do have it, like I said, you might see one or two withdrawals, but not to the level that we saw in your plan. It is going to lead to greater leakage. I guess what I might suggest is just watching this for a quarter or two to see if we see this type of level of activity again. And then if so, you could make a determination to turn that off if you'd like.
I should know this, but do we have any limitations on how much could be rolled out at that age? Or is it wide open?
No, it's wide open. It is.
Could we add a limitation? Or does it
I can double check on that.
Or does it have to be on or off? Just curious if there's a middle ground.
Everything that I've seen is on or off, but I can check to see if we can use a limitation on it. Like, for instance, 50% of the account or something like that.
Right. Okay. Yeah, I kind of hate to see the entirety of an account, walk out the door when someone's still employed. Okay.
Great.
The other question I had, and this may be for Brandon Chambers, the manager of benefits. URS, when they're in here speaking to our employees, do they talk about rolling over into URS as an option when our employees reach 59 and a half? I'm just curious how that.
I don't think they directly promote that. Most of the people that they meet with are planning for their retirement, so they are certified financial planners. They are talking to them about their URS funding. They can talk to them about their existing 401k that we have through Voya, but I don't believe they're giving them hey, you must or you should roll your money over into your URS 401k. I can follow up with our rep.
Well, I was just curious if that's, being encouraged. And I understand it's the state plan. We're all in the state plan. I totally get that. But I'm just wondering, and maybe it's an obvious thing. Maybe they're always going to be the biggest, recipient of our retirement funds. But I'm just curious why there is such a massive discrepancy there.
Is there a chance some employees do purchase years of service and they can use their 401k funding from Voya to purchase that? Would those be counted as a rollover to URS, or would that be counted differently, Bishop?
That would be, you're right, Brandon, it would. And unfortunately, all we see is it listed as a withdrawal. We don't see a breakout as to whether or not it's a service buyback or not. But you're correct, that could be used for that purpose.
So that could be why there might be some higher balances to URS when employees do purchase years of service towards their retirement. It is of a significant value, and they do use their 401k funds to do that.
Okay. And I'm not saying it's wrong or right. I'm just curious about how and why that's the case. Does anyone have any comments that they would like to make?
I think from our standpoint, not terribly surprising. I think it's URS are familiar with. I think where we would probably, you just want to make sure they're making a good decision. I know previously when we looked at URS, I mean, the plan is very bare bones.
It's limited.
And so you hope that they're not giving up a good option they've got here simply to move over in that regard. But at the same time, there's certainly reasons for it. I think maybe the thing that I would speak to, and this kind of speaks to the 59.5 too, is maybe what this is indicating, I think maybe from our seat, would be, is there an opportunity to provide some more education at that specific age group so that they fully understand what their options are, understand at 59.5 why that's in there, what the purpose might be. I think we would typically say plans, and I think Bishop said it well, on or off is typically what we see, and it really does depend on the plan, where you have earlier retirement. That's often in the case for a company. It makes a lot of sense to have it in there because it allows somebody who might be retiring before 65 to be able to take their assets and begin to move them to things that will generate income, right? I think your plan, the way it's set up, most retirement plans are set up not to be an income generator, because when you get to the point where you're going to live off those assets at that point, it typically is a different mix of investments and different type of investments altogether that you typically use. So, but I think and I know we've done retirement readiness that's targeted towards that to help that, but if there's even more specific around, hey, as you're 55 or here's the options you have, and even include URS in part of that conversation so that we can help walk through that.
Yeah, I think that's an excellent idea to, target those employees in that range who could be making that choice.
Yep.
And again, the whole idea is to just make sure they're making the best decision, for themselves. So instead of just wanting to simplify, they could have, better returns. So sounds like a job for Tucker.
Well, I was just going to point out, I mean, looking at last quarter's numbers too, URS wasn't even on the list. So it's probably one or two individuals that, when you look at how many participants there are in the plan, there will always be the ones that kind of slip through. I think overall, we always have a good turnout whenever we do the retirement readiness. And I think, that those have been effective in the past. So.
So I think Bishop's comment of, hey, over the next couple of quarters, let's keep a close eye on it. I think on the 59.5, one thing I'll say that is an area that you want to watch from kind of groundswell. In other words, you get a small group that starts, hey, by the way, at 59.5, you can take your money and you can go buy this Bitcoin fund that we all love. And I think we want to try and, help make sure employees understand what they're doing and from that standpoint. So I think we can watch it closely and then gear some education more towards that. And I think the last thing I'll just say is I think if there's ever a participant that says, hey, I have questions around this, again, Soltis acts as a fiduciary in that capacity, and we're qualified. Tucker's a CFP, the rest of our team to be able to talk to and say, hey, here's your options. Let's help you figure out what's going to fit you. So we're, of course, happy to help engage in that conversation, make sure they know what their options are.
And maybe just to help put the URS conversation in context, I looked at the file real quick. I didn't catch this the first time through, but one of the individuals that rolled assets to URS rolled almost $1 million. So there's, 90% of the dollar amount there.
Oh, okay. Good to know. Thanks.
Steven, plug it in.
Okay.
They are working on it. They are working on the air conditioning.
In the meantime.
Is there a place to plug it in? Oh, I guess it can be plugged in here. There is a plug
Say
right
those of
there.
us from St. George, it feels about right.
We might blow a
I
fuse.
just
but
need
yeah,
a
put that over.
hot air blow dryer on me, and I'll feel right at home.
Maybe. There we go.
Okay. Thank you, Bishop, for going through those, and we'll jump in here next. I think next on our agenda is we'll go through the investment report. So we'll jump on to page 31 in the packet.
Tyler, maybe just real quick, a comment about Bishop's material. Sorry, this is going to be super like detailed, and but on page 118, it shows the ending period plan assets for the 401k at the 153 million. 921,502.
Yep.
But then the graph on 120, quarter two 2023, that bottom number is 160,376,510.
Yep,
Is that describing the same period? Because
it is.
on 118,
That
the beginning and the ending are this exact same number down to the penny.
Purely an error on my part that I didn't catch as I finalized the report. Is that the 152 number is, or 153 number is the beginning balance. The ending balance should have been the 160 number.
Okay.
So I can
That's what I
update
thought.
that and send the updated report in. Yeah.
Okay. Just want to double check that. Thank you.
No, you're welcome. Thank you for catching that.
Okay. Good eye, Paul. Let's jump in here on the asset summary. And again, this is broken down by each plan. And this is pulling from our feed that we get from Voya as we look at it. So looking kind of at the end of last year through June versus end of this year, obviously some pretty good plan growth that's there. If you look at the allocations, that's one of the things that we're always looking at as we look at these from year to year. You can see no big dramatic changes, which is usually good news. That means we're watching to try and make sure that you've got participants that aren't, trying to chase the market in certain areas, which can be the case oftentimes. And so we look. Also, you'll see down there a weighted expense ratio of 0.38%. So that's the investment expense weighted based on where the assets are invested in the plan, well below, 0.5% with both. Again, a reminder for the committee, we have both actively managed funds in here where we have managers that in the plan that we're hoping will outperform their index and benchmark. And then, of course, we do have index options available. So for those participants that do want to keep their costs as low as they can, there's good options available in each asset class for that. You can see on the deferred comp plan as well. And maybe the one comment I'll make to start here is, especially as you look at the 457, the fixed account is the largest holding in the 457. That's not terribly surprising, probably based on the demographics. Maybe to speak to fixed accounts right now, if you were to look at Voya's as well as most other stable value, what we call fixed or stable value account, they are lagging in terms of what money market returns typically are. And that's because we've had interest rates go up quickly. So this environment's a little bit unique. We have had a number of participants, Utah County as well as others, that are calling saying, hey, why is our fixed account not getting 5%? And the reality is in those stable value accounts, in a normal environment, they can go out a little longer and therefore get a better yield. So a large majority of the time, your fixed account's going to have a better yield than a money market account. But in an environment where rates get pushed up very quickly like they have in the last year and a half, the money markets can reset because they're investing in things that are typically 3 months or less. And so that's something that we continue to watch and look at. I think right now as we look at that, based on projections, you'll probably see money markets continue to have a better yield over stable value accounts for 18, maybe even 24 months more. The challenge to that is we can't just flip and say, oh, well, let's just bring a money market in. These stable value funds, as many of you know, they have put provisions on there. And the reason those are in there is because to get a better yield, the fund managers will go in and say, hey, we're going to invest in things a little bit longer, but then at the same time, you have to be willing to hold these funds for a little bit. And you can't have a competing fund. So like with Voya, if you go through and look at your contract, you can't have a money market fund and a fixed account in the same space. They kind of look at them as competing. And so we'll continue to watch that. We've been working, and what you'll see is you'll see the rates of the fixed accounts continue to climb up, because as rates have gone up, they'll climb up as well, as they do have securities that they've invested in that mature, and they'll reinvest at higher rates. But that is a dynamic for you to be aware of. And I say that in that I think for those that are in your plan, I think with inflation the way it is right now, the worry Soltis has as an investor is, hey, if you've got most of your account sitting in there and you're earning less than 5%, you really are getting a negative return each year, and therefore your purchasing power is going down. So we want to help. I think we understand there's certain participants that that's where they want to be for safety, and they don't want market volatility, which of course they won't get. But we also want to try and help have that conversation. And then just help educate participants that, the fixed account is not a bad option, but this is a pretty unique environment where, like I said, 90+% of the time, your fixed account's going to have a better yield than a money market. But when rates keep getting raised about every 6 weeks, money markets can reset really quickly and fixed accounts cannot. So I'll pause there real quick for any questions on that.
Yeah, I was just curious if you're starting to see, bonds behave more normally, or are they still inversely
So
behaving?
you do have positive returns for the year, which is good, even though you've had a couple of rate hikes. I think the market has priced in those, I will say, on the shorter end. So one of the challenges last year is people typically invest in bonds for safety, and last year with rates going up as quickly as they were, they saw negative returns, which were in the double digits oftentimes. Between, I think the Lehman aggregate last year was off about 13%. That's a bad bond market. So you have seen that year to date. That aggregate is positive, not by much, but it is positive. Bonds are going to have a difficult go in a rising rate environment. And I think we're closer to the end than we are to the beginning there, but I would anticipate, the Fed has continued to verbalize that inflation is their biggest risk, and they'll continue to raise rates until they feel like they're starting to see the reaction. And the news there is kind of mixed. You've seen inflation begin to come down a little bit, but it's still much higher than we'd like to see it. The last number got revised back up, so a little higher than even they're contemplating. Probably everybody sitting in this room, this is unfortunate. Utah leads the country in a lot of things that are good. Inflation is one of the things that this state still is one of the highest states in terms of inflationary costs, which isn't not one that we want to lead, but it's a reality of kind of the growth of our economy and state as a whole. But so been a better year for bonds, yes, and at the same time, I think it'll still be a tough environment over the next couple of years until you start. When rates begin to go down, that's typically when you'll see bonds tend to perform their strongest. If we look at I'll go to page right behind the quantitative scorecard. Sorry, that number's. But the consistency report. And again, you'll see of all the funds we have in the plan, this is lining out your criteria that we have stated in the investment policy statement. Again, for the committee, we have strict criteria. Our belief at Soltis is that we want to have strict performing criteria, and we expect the funds in the plan to meet that. Those highlighted in green, we're kind of highlighting because they're performing by more than 1%. Anytime a manager outperforms by more than 1%, that's a very strong return that you're getting from them. You can see numbers that are quite strong. You got a couple of those that are north of 4%. The Barron's Fund, we've talked about this one in the past. We continue to watch it. It does have a pretty sizable concentration in Tesla. And that continues to help the fund. You can see it's outperformed its peer group by 12%. I think we would say we'll continue to watch that fund. We want to be careful. That fund has posted performance numbers that can be eye-catching, and therefore you might have a participant or two that goes, I don't know, that 50% return looks pretty good. I'm going to put all my money there. We look at that on a regular basis, and we'll continue to watch that. I think with this fund, it is concentrated, and we're aware of that. We continue to watch it closely, but it's continued to perform very strongly in the plan. So, and then of course you can see kind of all throughout. So you've got good performance in the fixed income space. You've got good performance across the equity space and in your target dates. You know, all of those are outperforming. 3 out of the 5 are greater than 1%, and the other 2 that are in there are very close to that 1%. The lowest being that 2050 at 0.68. Year to date, the T. Rowe Price funds have done a really good job. They've been in the top third and top quartile of their peer group in terms of overall performance. So we're pleased to see them. And then again, we kind of alluded to this earlier, but right at the bottom of that report, if you can go down one more, on the very next page, at the very bottom, where it shows the average excess return of 2.04%, and percent of managers beating the benchmark right now is just shy of 92%. Again, not to beat our chest here, but that's probably the highest number we've had since we've been on the plan. So it's really good to see the managers performing well. We've had a couple that have struggled. We've been patient, and I'll talk about that one next. This large cap growth is the SIA Growth Fund is T. Rowe Price's large cap growth team. That manager had a retirement at the end of 2021, very deep team. We met with them, felt really good about Paul Green, the new manager coming in. His track record was very good. The fund struggled for a little bit through 2022, and we were patient with it. Year to date, it's rebounded very strong. Right now, it's about 6% ahead of its benchmark. If you kind of look at that trending section on page 42, you know, it lagged pretty heavily, but year to date, the fund is up 35%, and that's 6% better than its peer group and index. And it's basically 11th in its category in terms of large cap growth funds. So we're getting the rebound in that particular fund that has had some struggles. And our recommendation there is to continue to see how that fund performs and keep it in the plan for now. It is technically still on watch because the 5-year number is still off a little bit based on the underperformance of 2021 and 2022. But if it continues to trend this way, it won't be on watch much longer. Let me pause there before we jump into the 2 asset classes that you asked us to come with some recommendations on. See if there's any questions from the committee on the existing funds in the plan.
None for me.
Okay. Maybe one last comment I'll make, and we'll take more time in the future, but for the managed accounts, which is obviously a large holding in the plan, as I think most of the committee knows, we are utilizing a collective investment trust in those. It brought the expenses down from your previous program. There's a all stock collective investment trust that we use, and then an all bond. And we also look at the performance of those. Both of those funds right now are outperforming since inception and in year to date on their performance as well. So the managed account is a little different because each portfolio is very customized to each participant. So if we were to put all those up here, it'd be more than 500 we'd have trying to look at and evaluate, because each participant gets their very customized portfolio. But what we do is we look at the underlying investments and how they're performing, and that helps us understand, hey, the investments that are the mix that's in there is performing well. Therefore, whatever the portfolio, you know, whatever customized portfolio they're getting, we know that at least the investments based on risk and return are doing well there. And again, those collective investment trusts, the reason we use those is because it brings the expenses for those participants, you know, down quite a bit from where they were, and still allows them to have a very customized portfolio that fits them, and it's looking at them constantly. So, okay, let's talk about the 2 asset classes that we discussed in our last meeting. Again, as kind of a response to the request, we talked specifically about looking at a real estate investment asset class option in the plan, as well as a inflation protected bond. And so if you go to page 43, For quite a few of our clients, we do have explicit real estate as part of the menu. We feel like it makes a lot of sense to have in a plan. The most common argument about having an explicit real estate option in a 401k plan is that you'll hear sometimes the argument of, hey, most people's biggest net worth is their home, and therefore they don't need any more real estate because their home's already it's the biggest part of their portfolio. I'm not sure we would agree 100% with that comment. We would agree that for most people, their home tends to be one of their largest assets. But I would also tell you that it's not very frequently that people are looking at that asset as a way to generate income in retirement. They still need a place to live. So, for example, when we help do retirement planning with many of our clients, we do income planning without the contemplation of selling their home to help fund it. And most of the time, clients are like, "Yeah, don't look at my house as a way for me to live, because I got to have a place to live." So I think for us, we feel like having explicit real estate makes a lot of sense. By no means, I think you've got good options in your plan, so not an absolute to add. But we actually have two options in here. Cohen and Steers is the manager that we have in many of our plans. It's our highest conviction manager. As you look there on page 43. So just kind of high level maybe for the committee. This is what's referred to as a REIT, a real estate investment trust. So a couple things for you to know. This has daily liquidity, meaning it trades just like everything else in your plan. Participants can move in and out of it every day the market's open. It prices and trades every day, so there's no illiquidity that you typically have with real estate. Two is this is not a leveraged portfolio. Cohen and Steers doesn't go in and borrow a bunch of money, purchase a bunch of properties and lever it up. So it's not leveraged in that regard. As a real estate investment trust, all of the properties they hold, it has to pass through 90% of the income. So the rents that they receive, income that they're getting, 90% of that comes back to the shareholders, and that's part of the return. That's part of the argument around why real estate's a good investment, is because you have an income component that has to be passed through. And then the last thing I'll mention is this is a fund that invests in diversified real estate portfolios. This is not a fund that's out there doing hard money lending to home flippers or self-improvement people or shows. So they're investing in commercial property at times. They'll maybe investing in single-family home units, those type of things that generate income. And then again, it's diversified throughout the country. It is a U.S. fund, so this holds real estate based in the U.S., not all over the world. You can see from expense, they're a little bit lower than kind of the average manager in that space, charges 1.09. Expense ratio for this fund is 0.88. Net of expenses, you can see it has performed very strongly. It's been a great hold for us and many of our clients. It's been in the first quartile almost 97% of the time in terms of outperforming its peer group. And since inception, which Cohen and Steers was really the pioneer in the REIT market. So they have the longest standing fund because they really built the first one. But you can see since inception, they've actually averaged just shy of 2% at 1.86% excess return above their benchmark that's there. So this is I would say our A option manager we've liked. We've held them in many of our plans for years, and they've been a very good, strong performer. We also brought an index option, which could be added as well. It's simply the real estate space you can index. Vanguard has a real estate index investor. Expense ratio, you'll notice it's quite a bit more expensive than your normal index fund at 0.26%. Oftentimes those index funds tend to be around 0.1%. So there's more expense to be invested in real estate, but certainly this offers a much lower expense, and it basically will track the index. So I think from Soltis' standpoint, we have our highest level of conviction in Cohen and Steers, but depending on price sensitivity and or if you want to add another index option, the Vanguard would be a viable option too. So I'll pause there and see if there's questions or comments about either one of those options.
Any worries about the investment trust with commercial real estate being hammered right now? I don't know what percentages they're doing, but that's always a concern right now with work from home and employees are starting to come back, but they're not completely there, and there's debate on what's going to happen there. But any feel for that?
Yeah, we're watching it closely. No, there's no doubt commercial real estate has been hit, and the outlook for it is is difficult. I think we do feel like that you're seeing that tide begin to turn. Maybe the best example, maybe some of you saw this last week, Zoom. The company Zoom
Right.
basically just required all their employees to come back to the office 3 days a week. So even the company that facilitates all this has said, hey, we've got to have people in the office to actually continue to deliver what we promise to clients. So, I think we do feel like that longer term it makes sense, but in the shorter term, if you're not careful in real estate, it can be painful, and there's going to be some more carnage yet.
Yeah.
I mean, you've seen a couple of shoes drop, but you'll see more. I spoke to leverage because I think that's where you see real estate investors really get in trouble. Because the argument on real estate is to make money, you've got to be levered. And there's a lot of truth behind that. And when you're levered and things go against you, you're kind of up the creek. So both of these funds would not have any leverage in them. They're both very well diversified in that regard. The other argument you would make is if you look at high inflationary periods, real estate has been a very good place to be. Between real estate and stocks, those have been the best two asset classes to help you keep up with inflation in terms of earning rates of return. So I would say in short, Kim, I would probably say this. In terms of timing, it may not be the most ideal time to add real estate, but I think longer term in the plan, it would make a lot of sense. And I'm not sure we could tell you and time it, hey, this is the right time to put it in, let's put it in here.
Sure.
So my thought is that, we surveyed the employees. We've been talking about this for 6 months, and we did agree to add this as an option for our employees if they wanted it. So I'm ready for a motion, but I'm curious, Brandon, you wanted to add something?
So the question that I have is, our employees are categorized either being under managed accounts or non-managed accounts. Really, those are kind of the two options. If the employees are under the managed accounts, they really wouldn't have the opportunity to make contributions to this asset class. Is that correct?
Partially. The short answer is yes, but in the portfolio, the all equity portfolio we run, we actually do have some real estate
You could
exposure.
roll that in, but you
We
could do
already
that.
have it.
Okay, so really, this would be for employees opting out of managed accounts, wanting to allocate some of their own individual contribution into that type of asset class. That was my question.
Yep.
So it's already being done under the managed accounts. It's just they can't pick this fund directly with that. That was my question.
Yep.
Anyone have any other comments or questions?
I guess the question is, do we want to add two or just the one?
My thought is just the one, because we're also going to talk about an inflation index.
Protected, yep.
We're going to talk about adding that as well. But as far as, the real estate, I think one's enough. That's my opinion. But
In prior meetings, we talked about reading a threshold of having too many options. Like once you get over, was it 22 options or something like that? You tend to see
21 to 25 is kind of the area that we feel like, hey, there's enough in there to help participants that want to build their own, have good options, but not overwhelm them.
And right now, we're currently at.
This would keep you within that. I mean,
Okay,
it would keep
right.
you.
That was my question. Thanks.
We count target date funds as one fund.
Yeah,
you?
they're typically looked at as one,
Okay.
kind of one option.
Yeah.
And remind me again of, I know Cohen and Steers is your A choice. Would there be a reason to add Vanguard? Is that more of a conservative approach?
No, the Vanguard is simply if you were to say, hey, we want to add this option, but we want to make it an index and have the fee be as low as we possibly can.
So it's really based on the fee, more
Because
or less.
in each asset class, what we've tried to do is give you options and have a passive option or an index option. So for those participants that are super sensitive to fees and just don't want to pay, and they're okay to just get the market minus a little bit of fee,
Okay.
an index option is good. So that's why we kind of brought both, as saying, hey, you could do both. I think our recommendation would be to start with one. If we saw assets really gather a lot of assets and people start saying, hey, I'd really like to have an index option there, it would make sense to add another one. but.
Okay, that helps clarify it for me. So I'll make a motion that we add Cohen and Steers as the REIT option to the plan.
Okay, we have a motion. Do we have a second?
I'll second.
Motion and a second. All those in favor say aye.
Aye.
That motion will pass 6-0.
And I guess we make the recommendation, but the commission has to fully approve that, right?
That is correct. We'll now, present it to the commission and add that to their agenda for final approval.
Okay.
Okay. The next one, as Ralph just mentioned, is the inflation-protected bond option. And so, again, as we've been talking for last year, when you have a rising rate environment, bonds become difficult. And so an inflation-protected bond option, what that's meant to do is give you an option where somebody that says, hey, I still want to be invested in bonds and be conservative, but I recognize that rising rates is going to eat away at my return. So what an inflation-adjusted bond option does, and this is on page 44, it's a portfolio that buys bonds that are called TIPS. And these are bonds that are pegged to the inflation rate, so as the rate goes up, the bond automatically resets. So that if rates are going up, your yield is going to go up with it. If rates are going down, your yield is going to go down with it. So it's meant to be a portfolio to help in high inflationary environments to protect against inflation that can, again, eat away at your return in a bond portfolio. In this particular asset class, TIPS or Treasury inflation-protected securities is really the main vehicle. In other words, the opportunity for an active manager to outperform there is pretty difficult. And so we actually, in this space, will just typically use an index fund because, again, a manager doesn't have the same type of breadth to kind of go and buy different securities that might be able to help their portfolio outperform in this space. So it gets you broad exposure through an index option. It's inexpensive. You can see here at 0.05%. And then if you look at, this is going to track the index, which is the Bloomberg U.S. Treasury U.S. TIPS index. And so it'll track that index, and you can kind of see the performance of it there. So that's the option that we would be our recommendation if the committee wanted to add kind of an inflation protectionary type of bond fund in the plan. Again, the purpose of this would be for somebody that says, I'm nervous about owning stocks, and I don't think I'm going to get enough return in a cash account like the fixed account. So I want to invest in bonds because they'll be more conservative, but I can get some yield. And that inflation-protected bond will help them get a yield that's more competitive with higher interest rates today. And if rates continue to go up, this fund will actually benefit from that as opposed to its detriment, which is traditional or what likely happens to a more traditional bond fund.
Yeah, I'm not sure if I have any questions on this
Did the
one.
survey reveal they wanted one of these as well?
Hey, Brandon, I know that one was,
This one was, had more affirmatives.
That's right.
Wanting this more than the REIT.
yeah.
Did it?
There was over 200 positive respondents to this.
And do you see this as a common investment option in a lot of your other plans?
Yep, we use it pretty regularly.
Okay,
It comes down to preference of the committee and kind of sophistication of investors, I think. So, but yes, it especially obviously in the more recent environment. The thing I would say is, you're all going to want to strangle me, but we don't see the inflationary environment. We're not going to find ourselves a year from now back to 2%. I mean, I think we're going to be here for a little while, and this type of fund will, provide a good option to those to kind of have some protection because bonds, if they push rates another even 50 basis points or 0.5%, you'll see another 4 to 5% come off bond funds.
you ever utilize this in the managed account?
We do. So if you look in our managed account, again, there's a stock option and a bond option. In the bond option, we have exposure to this particular holding. Yep. So again, it is for those that are in the managed accounts. This has already been in their plan or in their account.
And you would anticipate returns higher than cash holdings or money market?
In a rising rate environment.
In a rising
So, or
environment,
a high inflationary environment, yeah, we would expect to see returns from this fund be higher than what a cash account's going to give. I will say it's different in a cash account. A cash account will not fluctuate with the market. This will, and it will be much more minimal than like a stock portfolio, but it's still going to have some fluctuation day to day, and it will move, and it can go negative.
So remind me again, how many account or options do we have currently? And by adding these two will give us, I know we're under that number that you just quoted, but
Yeah, have you got that number?
I can't remember how many we have. 16?
So we're at 18, so if we were to add these two, it would put us at 20.
Okay, so we're kind of in that, getting close to the number. But I'd make a motion that we go ahead and add the Fidelity Inflation Protection Bond Index Fund to give the employees an option if they'd like to use it. And make that recommendation to the commission.
Okay, have a motion. Do we have a second?
I'll second that.
Motion and a second. All those in favor?
Aye.
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 Motion will pass 6-0.
And as always, we'll just offer ourselves up if the commissioners have questions or want to dive in deeper on either of these. We're more than happy to be part of the conversation or help go and provide some more in-depth look. Okay.
I voted in favor of that, and I'm in favor of it. But on the heels of the vote, do you see other gaps? I mean, if we're up at the 20 accounts, we're kind of getting close to maybe what I think our limit is. Do we have any real huge gaps out there? Like, we're going to come next time or in the next year or two and think, oh, we should really add this sector or that sector. And we say, well, too bad we added that bond index.
So as we look at your plan, there's nothing that's glaring to us. These were kind of, when we had the discussion with the committee, those were two areas that we looked at and did say, hey, I think kind of based on what we often see in a plan we'll do. I'm thinking in the managed accounts. The challenge with adding so these two areas I think kind of address where we would look and say, hey, these are probably two areas that would make sense to have in a plan. The other areas that we would look at, a little bit of the challenge there is there are areas to where you want to be careful, because once you make it an option, somebody can go in and say, I'm going to put all my money there. And I think what we would say is we use some things in the managed account sleeves where we use them in 3-5% positions, but you put them in a plan and you worry about somebody putting 30% of their account in it. And so I would tell you in there's some alternatives that that would be a consideration. When I say alternatives, I want to be careful. We're not talking like 3 times hedge funds leveraged, crazy stuff that you can't trade or whatnot. But we'd say if you look at some of the private markets like private real estate, private lending, there's definitely some areas in there that we use in our portfolios. Now, the tough part there, Paul, is candidly, you have to be in a mutual fund construct to do that, and there's really not mutual fund options for those as of today. I think that's going to change. I think in the next couple of years, you're going to see, just like real estate used to be this way, and then you had a few people that said, hey, if we put this into a mutual fund, we can have a lot more people that can invest in it. So I think you're going to see that coming from the alternative side. And when you say alternatives, that's a big, broad swath that's in there. The other one that I would say, but from Soltis' standpoint, you'd maybe have somebody that said, hey, we got to have some precious metals in here. We're not anti-precious metals, but when you look at them long-term, they have stock-like volatility and cash-like return. So you get all the volatility of stocks with a historical long-term return of about where cash is, which is usually not the type of investment, all the risk without a lot of the return. Now that's historically looking at them for 50 plus years. There's definitely been 5 or 10 year cycles where precious metals have looked and done really well if you've held them for that 5 or 10 year period. So that would be maybe the other area that I would say could be brought up, but that's one of those where I say you have to be careful because we've had a few plans that said, yeah, let's put that in there, and then you've had 10 participants go in and put their whole account in there, and then you then you're trying to make calls to them saying, I'm not sure you want to have 100% of your stuff in here. So, other questions?
Thank you for doing that.
Yeah, yeah, absolutely. We're, our committee, and Bill leads that committee, and went deep on both of those. So I think our last item here is kind of going through a recap of education. And unless there's Tucker's or anything else that I'm missing before we jump into the education, and you want to walk through
No, I think you covered it.
kind of what we have on the docket and what's been done.
Those are the major ones. And so maybe, yeah, I think that we're good to just maybe go into the final pieces here of education, the webinar series that we've been having, and then just the occasional one-offs that we've been doing with the employees. So maybe just first and foremost, as a broad sweep, just to get people educated. 4 times a year we have our webinar series. 3 of the topics we would say are often very fundamental, basic topics just to help people get started. And then we have a little bit more intermediate advanced topic, and that was one that we had this last week on Thursday, which was how Soltis constructs their investment portfolio. And so it's essentially a miniature ICM that we had with all the plan participants that wanted to hop onto that. And we know that was for the more sophisticated investors, people that usually have more questions about why don't we have a REIT in the plan currently, you know, what's your methodology, and walk through that. Had a really good turnout there. And then we just got the last one here in November that's going to turn up. As far as maybe here in the Valley, we did have in May a retirement readiness seminar where we had quite a good turnout from Utah County employees. And that is where we specifically covered retirement planning and investing, Social Security, Medicare, estate planning, and we've had some really good follow-up conversations with employees that had questions about that are getting ready for retirement. And so we think that's one of the more influential, the one that leaves employees that are close to retirement with a good list of action plans to follow. We like seeing that. And then just finally on May 26th, that was a busy week for participants. We recognize, because we had this meeting and then the next day we had the retirement readiness, but we went over the windfall elimination provision and the government pension offset like we mentioned, and that's where we had, was it 2? We had 2 meetings, right, Brandon? Doesn't feel like it was that long ago, but it was back in May. I think we had 2 meetings. Yeah. About 60 in each, 60 to 70 participants in each meeting, go over and had a good amount of questions of people that want to know a little bit more about how this impacts them. And then again, maybe just to summarize the education, you know, we're here 2 times a week and we're seeing, you know, compared to last year, whenever a plan converts, we're going to see a lot more people that want to meet just because they have questions about the new provider in and of itself. And so we saw at the beginning of the year, education kind of slowed down a bit. You know, just time of year, people aren't thinking too much about taxes at the time, and we've seen it start to ramp back up, and we're feeling back-to-back days again. And so it's good to see that people do have questions, and you know, about 80% of them are new people most of the time, and then the other 20% are actually ongoing conversations that we have with people. Maybe just as a final reminder, the managed accounts, one of the services we offer are building out the retirement plans, and that's where we look at them as if they were private wealth clients, but they're covered underneath the umbrella of the 401k, and that's where we put them in our private wealth software. We do some forecasting with them. We say, okay, this is what we're looking at when you retire. This is what we're looking at the next 30 years after that. And I think we've gotten some good turnout because that's been bringing a lot of people assurance as they get close to retirement. So any questions about education or maybe requests? I know we've made it out to the jail quite a few more times this year. I know we're going to try to make it out on Wednesday because Fridays, it sounds like it's probably a sporadic schedule at that time. So that is one thing that we're aware of. And then anything else, Brandon, that we missed there?
No, I think it's been appreciated, their willingness. They've met out at like the Public Works location, out at the Utah County Sheriff's Office. They meet in the health departments. When originally they used to always be kind of central here, but what we found was people just couldn't make it to this location. So we also would love to try to do one at the health department at the Salem location, and also possibly like a half day up at the American Fork location. See if we could just really make it work. Because I mean, they're flexible to meet wherever, and they've been really good to meet the needs and the demands of our employees. I mean, our schedule fills up pretty much every time.
Yeah.
With 2-3 advisors, multiple days, so they do great.
I was going to say, we have, I know to this committee, we added another advisor, Fano Barton, that is primary with Tucker, but we have another that we just added to our team as well, just kind of with Utah County growth, but our growth too as our firm. And so we'll have another CFP advisor that's that can be available to help with that as your plan continues to grow. And
Hey, was your meeting out at Thanksgiving Point, was that recorded?
That one was not.
That one wasn't, okay.
But we do have a recorded version of that meeting. So we've done it virtually and recorded it. So we do have a recording that we can,
Is that, and how do we,
Well,
we can,
because that one is on site in person, and then the one that happens in October, November, that one is virtual, and we do record that one. And so we have last year's recording available,
yeah,
and
which we can send out to
Yeah.
you.
yeah, would you?
Yeah, absolutely.
The one that, I don't necessarily need the live one, but if you've got one similar to that with the
Yeah.
slides and stuff, because I wasn't able to go, but.
yeah.
And is there a repository where employees can go to get past recorded? I know you send out links
So
after the fact.
We do.
but-
We send out the link. We from a compliance standpoint, they typically we can leave those out there for about 6 months to a
Okay.
year, and then we have to pull them off because
Sure,
you leave them longer than a year,
yeah, stale.
then it becomes. There's some things, additional things we have to do in terms of compliance and filing, and as well as other people trying to get into our website and get to them. But so they're password protected, but so they'll be out there for about a year, and then we're doing them regularly enough to where we, anything, almost every webinar we do, we record so that we can use it or have access to it.
Okay, that's good to know.
Yeah.
Perfect.
Okay. I think that gets us through our agenda items.
Oh, maybe the last thing there, as far as the agenda goes. I know Voya and Soltis is working together to get those just 2-minute videos of the website, just how to navigate simple things like where do you go to change investments, where do you go to update contributions. So we're finalizing the material and then we'll record them. And so there'll be 2 to 3 videos just walking people through the websites, something simple that they can access. So, and I don't know, Bishop, if you're still on, if you have anything else to add to that, any follow-up as far as videos?
No, not much to add, other than I should have something for you to review next week,
Okay.
Tucker. So getting closer to, having it in final format at least.
Okay.
Hey, Bishop, assuming too with the new dashboard that you're rolling out, I'm assuming too there'll be probably some introductory material, potentially a video as well. So I think, that might be between now and the end of the year, a good opportunity to help refresh and remind participants to go. You'll see our November, our fourth quarter participant session is on kind of an annual checkup. We're trying to teach these employees like once a year you should be going in and just, spend a few minutes. You can call us, set up 15, 20-minute appointment and make sure your account, is really reflective of who you are and what you're doing. So, okay.
Yeah, I should be receiving some kind of training and update on where that is. All I've seen is a few screenshots so far. So as soon as I have something in the mix, I'll reach out to you both as well.
Okay.
Now would be a great time to go check it because it's been a pretty good
It's good
quarter.
now. You haven't looked at it in a year, go do it now.
Yeah, I know most people don't go there because they're so worried about what they're going to see.
It's probably, I'm sure you all can empathize. When things go right, it's the expectation. Hey, it went right. That's how it should go. When it doesn't go right, it's, hey, what's going on? Why isn't this being done right?
Yeah.
So, okay. Any other items or questions from the committee?
No, I don't, I'm not aware of any other items, although I did want to just confirm our next meeting will be an educational session on Secure Act, 2.0. And so we should just be ready for that and prepare for that. Usually we prepare about like 5 minutes before it starts. So
We'll come prepared. I know there'll be questions and we'll be ready. So I mean, if you're
I'm
able
not
to
worried
kind of
about
read
you
through,
guys. No. As long as that's okay, Paul.
Is that our next quarterly meeting?
Yeah.
So it'd be in November or
It'd be on the
October?
same date that we have this scheduled for and, 3 months from.
Okay,
now.
so it'll be the November meeting, and I think I mentioned to you that that's the same week that we have the UAC
Oh, that's right.
conference.
Oh, maybe
and
we
and
could
the,
look
the
at,
Monday's okay. I think
Right.
it's the Tuesday.
Yeah, yeah,
which is
yeah.
The other meeting,
Um,
but just as a point of
hmm.
information.
You act in St. George?
It's
Yes.
it's UAC in St. George. Oh, it is in St. George. What do you think about? Would that be overkill?
Usually November's pretty nice in St. George.
Yeah.
You
If you're all
talking about
headed that
having the
way,
meeting down there or
we
what?
can certainly facilitate it down there. We'd be more than happy.
Okay, we will. Does anyone have any thoughts on that? Since we're here talking about that,
I
what
don't
if-
know if everybody goes down for you.
Oh, that's true.
Is the only issue. I
We
bet
could do a
is
hybrid
one that probably
in
doesn't.
person and via Zoom.
Yeah.
And we've got our conference room in St. George that we've got the ability to have everything up on screen. And
I'm certainly open to that idea. I would think that maybe on Tuesday we do this training instead of Monday in St. George. I'm just throwing that out so that it
Okay.
doesn't extend the week too far, unless you have UAC activities on Tuesday.
Usually not on Tuesday.
That's my thought.
It's a travel day. You could go down a little early and be there for the meeting, which
afternoon.
would work. And then what? Just move the benefits over to Monday.
Yeah.
Yeah, and if there's a Zoom component, maybe that would work for everybody.
Yeah, if for those who can't attend and are unable to go down, we could have teams. So for those people, anyone think that's a bad idea, or we can talk later. I suppose. So if we go forward with this idea, we would have our training on Tuesday afternoon, prior to UAC in St. George, but we would move the Tuesday afternoon to Monday, which is the benefits component of this committee, and that would be here. And
I kind of like the idea because I don't know if I've ever been in your office. Have I
we'd
been
love
in
to
your
have you.
office?
We've got a nice big conference room that's got plenty of room for all of us, and then we can pipe in and have on screen those
Yeah.
that may need to join virtually. And
I think we should do it
I like it.
we'd love to have you.
as long as we have the option for those who can't attend to join by teams, which we would. Then I think we're fine. Okay. All right. PJ has all the notes on this, so
I'll contact you after the schedule to make sure there's no conflict.
yeah, I don't think there's anything on Tuesday that we need to attend. At least that I need to attend.
Right.
You might need to.
No, as far as I know, I'm okay on the usually it's just a travel day. So.
Yeah, the advantage of that is it, makes use of, kind of a wasted day. You know what I mean? Because it's just a travel.
Have you been down to their offices? And
I have not.
I don't think I have either. So it'd
we'd
be
love to
kind
have
of
you.
fun to.
It'll be Wednesday afternoon. They want lunch too.
Okay.
We can do that.
We can do that.
Yes, we do.
was looking out for us,
We can certainly do lunch. Or
And this would be Tuesday, not Wednesday.
Correct.
It's Tuesday. Yeah.
But
Okay.
I'll double check with UAC to make sure it doesn't conflict with UAC schedule.
Okay, great.
So
Okay.
that's Tuesday let me just double check.
Yeah,
Tuesday the 7th?
No, it's
14th.
later in the month.
Okay.
It's
Is it
like
the
the
second week?
17th, I think.
Yeah, it's like the. I
Yeah.
think that's
So
right.
it'd be like 14.
14th. Okay, let me,
14th is the Tuesday.
yep.
Correct. Yeah, so it'd be the 14th.
Yeah. I don't have mine up in front of me, so
I don't like my phone calendar.
Okay, I think that's a plan. I'll send out,
We'll make it work, yeah.
the request to you guys, and then you can just firm up a time, and we'll go from there. Planning in like the afternoon of Tuesday.
right.
Yeah.
Okay.
Okay.
November 14th, I'm predicting now
Sunny?
74.
Since you're
We'll see if-
predicting
we'll see
the
if we are
the
all
weather,
remember.
how about the football standings in November?
All I know is I'm excited to see.
Yeah, lots of questions
Thank,
this year.
thank
Excited about
goodness
the
we
Big
finally got
12?
BYU and Utah back into a conference
Yeah,
together.
there you go.
Everybody's life in Utah just got a little better and a little more feisty for one more weekend of the
Yeah,
year.
there you go. Crazy.
Okay, I think that's everything. Should we go ahead and adjourn?
Yeah, motion to adjourn.
Second? Yes. Favor?
Aye.
Aye.
We're adjourned.